Hello, my name is Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of LME 3-month copper, aluminium and lead.
LME 3-month copper. The V-top over the middle of May drove this market lower in recent times, down through three important congestion zones below. The previously often mentioned and discussed congestion zones 97.50 to 99.95, the next congestion zone between 93.95 to 96.06, and most recently down through a smaller one between 91.83 to 92.56, and down to test a combination of 50% Fibonacci line to July 22 to May 23 move, and the gold highlighted long moving average currently at 90.11. In the process of moving lower, the market exited one pattern and straight into another one. From a bullish Andrews pitchfork into a narrow descending wedge pattern. And since the middle of June, out of this pattern into a mid-June to early July dark blue highlighted bearish shift pitchfork. Right now between the overhead middle time, currently at 91.09, and the lower time below, currently at 87.36. I've utilized this bearish shift pitchfork as an indicator of the bearish angle of attack until something else develops. Below the gold highlighted and rising long moving average, you have an empty zone with nothing apart from the dark blue lower time until we reach the purple highlighted fairly flat extension to the upper trend line, currently at 87.74, of the June to August 2023 ascending triangle. Now, this on its own is not that important, I suspect, but it is the gateway to a whole load of congestion below, dating from late last year down to the 81.15 level. So it's worth noting. Now I'd like to review an idea I put forward 5 weeks ago, and I quote, I'd like to put one other idea in front of you, and it is this. The whole V-top from February to date may not be a simple V-top, but a V-top with an extension. In these types of V-tops after the peak, the market may start moving lower, but then form a hesitation or a congestion of sorts, usually a pennant or a bear flag type pattern, on the way lower. This might be the case here, so I would suggest holding fire and writing off and retiring the pitchfork or the wedge pattern until the current move sideways sorts itself out. Could after all be just a hiccup on the road lower. End of quote. This seems to be a situation now, and the action specifically over June and early July seems to be a halfway hesitation of sorts. If that plays out, then the opportunity to move down to the 8600, 8700 zone could now become a very real possibility. LME 3-month aluminium. The move higher over March, April and even May originates back in late February, with the market breaking higher from a diamond pattern type formed between late October 2023 to late February 2024. Now please remember this pattern as we are today once again entering those levels, though obviously not the pattern itself. The next feature was the big spike higher on the 15th of April that ended up as an indecisive doji cross of all things. This huge move showed some of the topside potential for the next few weeks. In late May, the market made further new recent highs, but at the same time sowed the seed of its own bullish destruction by making a 2-day pipe top that was also part of a larger 2-week horn top. Prices have in essence moved lower ever since, though with a small halfway hesitation in early June and a larger one over mid-June to mid-July. The shape of the move lower was in a descending wedge pattern. It was quite narrow and very acute, and prices exited out of it in late June. I said 6 weeks ago when this started to happen that, and I quote, Prices are now entering a wide congestion band between 24.37 to 25.15, which looks quite a disconnected zone, but in truth does work together. What is most important about this zone is that it's the beginning of a move down from the second of two patterns. It's a large, mid-April today, possible double top pattern, Adam and Eve type. I call it a potential pattern as the neckline for this double top is around the 25.08 to 25.15 area. And though we have penetrated it, we have not as yet had any consecutive closes below it, but if it does, then this pattern will, as I said last week, so that's 7 weeks ago, and I quote, will determine the next phase of this market. However, without formally calling them as potential pattern targets, I can give some idea of the destination of the moves should they be confirmed in the coming week. Thus, a primary target would be in the 2400 zone, with a secondary hard to reach target in the 2300 zone. End of quote. So, that is a long quote, but it details what was happening and where the opportunities were down at 2400 and then at 2300. Since then, indeed, 2 weeks ago, prices dropped down to the 2400 level and last week reached 2300. The secondary hard to reach opportunity. The market has continued low and we are back in the same price zone as the earlier diamond bottom pattern, roughly between 2400 to 2100. We now have overhead the October 2018 high at 2267. The neckline extensions of the October 22 to May 23 head and shoulders top currently at 2321. And the March to May 2023 head and shoulders top currently at 2335. As well as congestion at 2345, the June 2018 high at 2353, and the flatlining gold highlighted long moving average currently 2358. I should actually say the October 2018 is a little bit higher than that. That was down at 2267. I got that one wrong. So it's not 2218. It's at 2267. Anyway, with the market in between the overhead middle time and the lower time below at the moment, which is currently at the lower times at 2171. Now, I'll continue utilizing this dark blue bearish shift pitch hook as the indicator for the bearish angle of attack for this market until it stops being so, which might not be too long as it's quite steep. Looking below in amongst the late 2023 congestion, we have the October 2018 high at 2267 and the bright red neckline extension currently at 2230. The June to July 2023 reverse head and shoulders continuation pattern, and that is being challenged today. Then we have the August 2018 high at 2178. As I said last week, not a whole lot of the support looks that great. So we'll have to rely on the overall congestion from last year to slow and halt the declines, plus one other factor, and a larger, in the move down since May, the market made a small halfway hesitation, and the larger late June to early July hesitation. And the full potential for the second move lower has been achieved. We are currently experiencing prices overshooting lower. It'll be interesting to see how far they overshoot and when they will finally stop, because we are moving beyond what was anticipated from the patterns that we have already. LME 3-month lead. I said 19 weeks ago here, and I quote, I suspect the key overhead resistance will be the same as in late January, the congestion between 2182 to 2189. End of quote. Now please remember this quote, or rather remember that 2182 to 2189 level as it become relevant again. So the big elephant in the room, as I called it now for 11 weeks, was the mid-February to late March bullish Andrews pitchfork. In late May, the market breached the upper time, but it repaired itself, or so it seemed. But the breach allowed a bearish inflection to set in that ended up being a horn top over late May, which was the high point of the recent move upwards. Moving into June now, and we saw prices fall below the neckline of the horn top. By the end of that week, had punched down through congestion from around two significant 50% Fibonacci supports, the one for the whole of 2022 at 2025, and the one for the June to October 2018 move at 2221. In doing so, the market also reached the primary target for the horn top at 2215 and the secondary hard to reach target in the 2173 zone. The market continued driving lower, down towards the next congestion, a wide band originating from April between roughly 2135 to 2186, which has three 50% Fibonacci lines within it. The November 2023 to May 24 move at 2176, the May 2023 to May 24 move at 2167, and down at the lower end, the March 2020 to March 22 move at 2135. In the process of driving lower, the market formed an acute, narrow bear channel. And I said 7 weeks ago, and I quote, "Until prices break out of this dark blue bear channel or morph into some other pattern, then this pattern will run things," end of quote. Well, 6 weeks ago, we saw just that, with the market moving up to the resistance band between 2213 to 2225, and even breaching it. However, the metal didn't like it up there and turned back down towards a whole combination of supports between 2186 to 2135, which I highlighted at the beginning of my commentary. The 2182 to 2189 congestion, that's where it comes in now. This time prices punched down through it, closing below the long moving average 2 weeks ago, and to a fairly free zone below, bar the congestion seen at the beginning of this year, all the way down to the combination of the congestion at 2058 and 2038, and the newly drawn dark blue highlighted middle time currently at 2028 of the late May to mid-July bearish Andrews pitchfork. From here we see the start of 4 separate supports at 2058, 2039, 2021 and 2002 that form the next congestion band below. Now, taking a step back, the decline from the horn top in late May led to a halfway hesitation from mid-June to mid-July, and we are now on the second leg lower. The bearish halfway hesitation has potential down to the 2050 zone, which we have achieved. And anything we see lower is overspill on the downside. So until something else comes along, the dark blue bearish Andrews pitchfork will show the bearish angle of attack of the overspill lower. And we have support assaults all the way down to the 2001 level.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.